Starting a business is not an easy undertaking for any entrepreneur. The process demands a lot of research, engagements, and exploring various options to achieve the intended results. A key consideration in completing the business startup cycle is the source of funding for the startup business. In this video, we will explore some of the common funding options available to a startup business. The startup funding value chain refers to the process through which startups secure capital to fund their startup phase, growth phase, and operations. First, let's talk about bootstrapping. Bootstrapping refers to the practice of funding a startup using personal savings, revenue generated by the business, or contributions from friends and family. Bootstrapping allows founders to maintain control and ownership of their startup without diluting equity. However, it may limit the scale and growth potential of the business due to resource constraints. Next is seed funding. This is the initial capital raised by startups to validate their business idea, develop a prototype, and conduct early market testing. Seed funding is often provided by angel investors, venture capital firms, VCs, and early-stage startup accelerators, with amounts typically ranging from tens of thousands to a few $1,000,000. Series A funding is the first significant round of institutional investment, raised by startups after proving their business model and achieving initial traction. Typically led by venture capital firms, Series A rounds often range from a few million to tens of millions of dollars. As startups scale their operations, expand into new markets and accelerate growth, they may raise subsequent funding rounds known as Series B, C, D, and so on. These rounds may involve a mix of venture capital firms, private equity investors, and corporate venture capital, with amounts ranging from tens of millions to hundreds of millions of dollars or more for established unicorns. An initial public offering, or IPO, is the process by which a startup or private company becomes publicly traded on a stock exchange, offering shares to the general public for the first time. IPOs enable startups to raise significant capital, provide liquidity to early investors and employees, and enhance the company's visibility and credibility in the market. Even after going public, companies may continue to raise additional capital through follow-on public offerings, secondary offerings, debt offerings, or convertible bond issuances. Post-IPO funding can be used for various purposes, including acquisitions, research and development, expansion into new markets, and debt repayment. Mergers and acquisitions, commonly known as M&A, involve the acquisition of startups by larger companies or other investors for strategic expansion, talent acquisition, or technology integration. M&A transactions provide liquidity to existing investors and founders, offer exit opportunities, and enable startups to leverage the resources of larger companies for further growth. Finally, secondary market transactions involve the buying and selling of shares of privately held startups or pre-IPO companies among investors. These transactions provide liquidity to early investors and employees, allowing them to monetize their investments before an IPO or acquisition. The startup funding value chain is dynamic and can vary based on industry, geography, and market conditions. Startups may navigate different stages of this value chain as they grow, seeking appropriate funding sources to support their development and achieve their strategic objectives. Thank you for watching. Don't forget to like, share with friends, and subscribe to our YouTube channel for more insights on business funding.